Every nation on this planet carries debt. The United States alone shoulders more than $38 trillion. Japan owes roughly $9 trillion. And when you add up every government, corporation, and household across the globe, the figure crosses $315 trillion, an amount nearly triple the size of the entire world economy. But hidden inside these numbers is a paradox that should make every rational person uneasy. If everyone is drowning in debt, then who exactly is the lender? Who is the mysterious entity the world supposedly owes? The truth is not what most imagine. When you trace the chain of creditors, when you follow the paper trail of who actually holds the debt, something unsettling becomes clear. The world does not owe money to one specific person or group. Instead, the world owes money to itself. But that structure did not emerge by accident or by nature. 4 men, 4 bankers across 3 different centuries, built it intentionally. Each one designed a mechanism that transformed temporary borrowing into permanent dependency. They created a world where governments do not repay principal, where interest never stops flowing upward, and where debt is engineered to grow forever. This is not conspiracy. It is historical record. The meetings happened. The contracts were signed. The blueprints exist. And when you understand how this system was constructed, you realize something chilling. The $38 trillion of American debt is not a mistake. It is the system functioning exactly as intended. So let me introduce you to the 4 architects, the 4 critical turning points that forged the global debt trap, and explain why every modern government is now locked inside a machine with no exits. We begin before the year 1694, when borrowing looked nothing like it does today. Kings who needed money turned to merchants, nobles, or wealthy families. They promised repayment with interest. If they failed, they defaulted, the lenders lost their investment, and the king found another source. It was a crude system, filled with risk, embarrassment, and negotiation. But it had one crucial quality: it ended. Debt was either repaid or written off. The slate eventually cleared. Then came William Paterson, a Scottish merchant and ambitious financial schemer. After several failed ventures, he stumbled onto an idea that would reshape the entire world. In 1691, England was locked in war with France. King William III desperately needed money. The royal treasury was dry. Tax revenue was insufficient. Traditional lenders were backing away because England had defaulted previously. Paterson approached the king with a proposal unlike anything seen before. He would assemble a group of wealthy merchants to lend the crown £1.2 million, roughly equal to $300 million today, an enormous amount at the time. But here was the revolutionary twist: the loan would never be repaid. Instead, the government would pay interest on it indefinitely, 8% per year, forever. To manage this unprecedented arrangement, Paterson proposed creating a new institution, the Bank of England. The mechanics were astonishingly clever. The merchants would deposit their gold with the Bank of England. The bank would then lend that gold to the government. In return, the government would make annual interest payments, funded by taxes. The bank would then distribute that interest to the merchants. And here is the critical part: the principal, the original loan, would never be returned. Why would wealthy merchants accept such a bizarre deal? Because the interest payments were guaranteed by Parliament and backed by the full taxing power of the English government. As long as England existed, and as long as it could tax its citizens, the interest would continue flowing. Even better, the merchants would receive paper notes from the bank representing their deposit, notes they could trade, sell, or use as money. These notes were effectively better than gold because they generated income. Parliament approved the plan in 1694. The Bank of England was born. The gold was deposited. The government received its war funding. And for the first time in human history, national debt became permanent. Not a temporary liability, but a structural feature of government finance. And here is what most people never learn: this system was extraordinarily profitable for the lenders. 8% interest on £1.2 million meant £96,000 paid annually, forever. The merchants had essentially purchased an eternal annuity backed by the government. And if they ever wanted their original value, they could simply sell their notes to someone else, transferring the debt without ending it. But Paterson's true genius was in the next move. The Bank of England was granted the right to issue paper money backed by the government's debt. This meant that the government's IOUs effectively became currency. The more the government borrowed, the more money the bank could create. Debt became money. Borrowing became creation. And interest became a permanent obligation paid by the public. This is the template still used today. Governments borrow and never repay principal. They pay interest forever. And the debt circulates as an asset within the financial system. A brilliant design for bankers, a lifelong burden for taxpayers. Within half a century, every major power in Europe adopted some version of Paterson's model. France created its own national debt apparatus. The Dutch formalized government debt issuance. And by 1790, the newly founded United States, under the direction of Alexander Hamilton, adopted the same principles: permanent debt, interest funded by taxes, and government bonds circulating as tradable assets. Paterson died in 1719, not particularly rich, despite creating one of the most powerful institutions in human history. But his invention, permanent sovereign debt, still exists more than 3 centuries later. British government debt has never been eliminated. It has been refinanced, rolled over, expanded, but never brought down to zero. The trap was set in 1694, and every government that followed walked straight into it. Now, Paterson built the foundation, but it was Nathan Rothschild who turned it into a global industry. By the early 1800s, European governments had fully embraced the idea of sovereign debt. They were borrowing for wars, for development, for imperial ambitions, and even for basic operating costs. But the system still lacked something essential: scale. Each government negotiated separately with wealthy merchants. Interest rates varied. The market was fragmented. Only a handful of elites could participate in lending to nations. There was no unified market, no liquidity, no global structure. This was the environment Nathan Rothschild stepped into and completely transformed. The Rothschild family began as modest money changers in Frankfurt, but by the turn of the 19th century, the 5 Rothschild brothers had expanded into a financial network unmatched in history. They established banking houses across 5 major European capitals: London, Paris, Frankfurt, Vienna, and Naples. This gave them something no one else possessed: the fastest and most reliable international financial communication network in the world. Nathan, operating from London, was the strategic mastermind. During the Napoleonic Wars, Britain needed constant funding, and Nathan Rothschild provided it, not only by lending directly, but by reinventing how government borrowing worked. Instead of simply giving money to the crown, he bought government bonds in bulk at a discount, then resold them to investors throughout Europe at a markup. In modern terms, he created an international secondary market for sovereign debt. Governments got immediate money, investors got a tradable asset, and Rothschild pocketed the difference, repeatedly. But his true power came from what he built around those bonds. He became the central hub of financial information. His couriers moved faster than official government messengers. No one in Europe, not kings, not generals, not diplomats, could match the speed of the Rothschild network. And this gave him an information advantage that reshaped markets. The most famous example happened in 1815, during the Battle of Waterloo. Nathan Rothschild received news of Napoleon's defeat before anyone else in London. With that knowledge, he executed a maneuver still taught in finance circles today. First, he quietly sold British bonds, creating the illusion that Britain was losing. Investors panicked. Prices plummeted, and in that moment of fear, Rothschild began buying massive quantities of those same bonds at rock bottom prices. When the official news arrived the following day announcing British victory, bond prices soared. Rothschild's profits were enormous, not because he cheated, not because he bribed anyone, but because he controlled information and understood market psychology better than anyone alive. This event cemented the Rothschild dominance. Governments realized something crucial. If they wanted to borrow money efficiently, safely, and at scale, they had to go through the Rothschild network. No one else could move money across borders, find international investors, or stabilize markets as effectively. By 1820, the Rothschilds were the financial gatekeepers of Europe. Now comes the dark part: the innovation that tightened the global debt trap. Before Rothschild built his system, sovereign default was inconvenient but survivable. If a king refused to pay, his lenders suffered losses, and the system reset. But when Nathan turned government bonds into international, widely held interconnected assets, default became dangerous. A single country refusing to pay no longer just hurt one creditor. It triggered cascading losses across multiple nations, institutions, and markets. Picture it: a British bond might be owned by a French investor who sells it to a Dutch bank, which uses it as collateral for a loan to an Italian industrialist, who then reinsures that loan with a German financial house. One missed payment in London could ripple across the continent. Rothschild engineered this interconnection intentionally, because once debt became global and entangled, default became unthinkable. No government could risk causing a Europe-wide financial collapse. They had to keep paying, no matter what. Even better for the Rothschilds, if a government needed to refinance its debt, they almost always had to return to the same family that dominated the market. This was the second key lock in the global debt trap: make debt so interconnected that no government can afford to default. By the mid-1800s, the Rothschild family was unquestionably the richest in the world. Their wealth surpassed kings. Their influence shaped wars, diplomacy, and the financial architecture of entire empires. and yet they produced nothing material. Their fortune came from one source: interest on government debt. Paterson had created permanent sovereign borrowing. Rothschild industrialized it, globalized it, and made it systemic. But across the Atlantic, a new financial empire was rising, one that would take the debt machine to an even higher level. By the late 1800s and early 1900s, the United States was becoming the world's next economic superpower. But its financial foundations were still primitive. Banks operated independently with little coordination. The money supply was tied to gold reserves, and there was no central authority to manage crisis or stabilize markets. Then came the Panic of 1907, one of the worst financial crises in American history. Stocks crashed, banks collapsed, public confidence evaporated, and into that chaos stepped one man, John Pierpont Morgan. J.P. Morgan, already America's most powerful banker, personally orchestrated the rescue of the U.S. financial system. He summoned New York's leading bankers, locked them in his private library, and forced them, sometimes aggressively, to commit their own capital to stop the crisis. Astonishingly, it worked. Morgan became the unofficial central banker of the United States. But Morgan understood his age. He was in his 70s. He knew he would not live long enough to repeat this heroic intervention. So he and his closest allies, the titans of Wall Street, needed a permanent fix. They required a central bank. The problem: Americans despised central banks. They had shut down two earlier attempts because they feared concentrated financial power. So Morgan's circle devised a plan: create a central bank disguised as something else. In 1910, Senator Nelson Aldrich, along with representatives from Morgan's banking interests, including powerful financiers from major institutions, gathered secretly on Jekyll Island, Georgia. For 9 days, they drafted the architecture of what would become the Federal Reserve System. The secrecy was absolute. Participants used fake names. Travel arrangements were hidden. Even the staff on the island had no idea that the nation's future monetary framework was being crafted there. They knew the public would revolt if they learned bankers were designing America's monetary system. So the final design was intentionally misleading. The Federal Reserve would not be called a central bank. It would be called a system. It would not appear centralized. Instead, it would be split into 12 regional banks. It would not appear controlled by Wall Street. Instead, it would publicly have government oversight. But beneath the surface, the structure ensured banker control. The regional Federal Reserve banks were privately owned by member banks. Member banks elected their boards. Those boards, in turn, selected key officials for the system. And the most powerful branch, the Federal Reserve Bank of New York, which handled government bond purchases and monetary operations, was effectively under the influence of Wall Street giants, especially Morgan-affiliated institutions. In December 1913, Congress passed the Federal Reserve Act. Many lawmakers who voted for it barely understood the implications. And with the stroke of a pen, Morgan and his circle had transformed the American financial system forever. Immediately, the debt trap expanded in a way Paterson and Rothschild could only have dreamed of. Because the Federal Reserve had one transformative power, it could create money out of nothing and use that money to buy government debt. This removed the natural limit on borrowing. Banks previously had finite reserves, but now the Federal Reserve could generate unlimited demand for government bonds. When the government needed money, it issued bonds. The Fed bought them using newly created dollars. The government spent those dollars, and taxpayers became responsible for the interest. This was the third lock in the global debt trap: make debt infinite by giving central banks unlimited purchasing power. Morgan died in 1913, the year the Federal Reserve was born, but his influence shaped a century of borrowing. Next came the final architect, the man who made the debt trap permanent worldwide. By the 1970s, the debt machine engineered by Paterson, expanded by the Rothschilds, and institutionalized through Morgan's Federal Reserve, was running smoothly across wealthy nations. Governments borrowed endlessly, refinanced routinely, and paid interest forever. But the developing world was still outside the fully locked system, until one man's decision pulled them in permanently. Paul Volcker, chairman of the United States Federal Reserve from 1979 to 1987, did not intentionally set out to globalize the debt trap, but the steps he took sealed it for the entire planet. In the late 1970s, America suffered from double-digit inflation. Prices were rising at more than 10% a year. Confidence in the dollar was collapsing. Foreign governments were questioning whether the United States was still the anchor of global finance. Something drastic was required. Volcker responded with the most aggressive monetary tightening in American history. He raised interest rates from roughly 11% to nearly 20%. Inflation fell sharply, but the consequences were catastrophic for developing nations. Throughout the 1970s, Countries across Latin America had borrowed heavily in dollars because interest rates were low. When Volcker raised rates, their debt payments exploded. Mexico owed around $80 billion. Brazil owed $60 billion. Argentina owed more than $40 billion. And suddenly, none of them could keep up. In August of 1982, Mexico told the world it could no longer pay its interest, a default. And because major American banks had lent the bulk of this money, a default threatened to collapse multiple Western financial institutions. Volcker had two options: allow the defaults and let the system reset, or protect the banks and preserve the architecture. He chose preservation. Working with the International Monetary Fund, Volcker helped engineer a financial rescue that forced developing nations to keep paying interest indefinitely. The IMF provided structural adjustment loans that were never meant to reduce debt, only to keep the interest flowing to American and European banks. But these loans came with punishing conditions. Governments had to cut public spending, privatize industries, reduce protections, open markets to foreign corporations, and even devalue their currencies. In short, they surrendered economic sovereignty in exchange for the privilege of staying in debt. And the debt itself, it was not eliminated. It was rolled over, extended, and made permanent. This was the final lock in the trap. When nations cannot pay, do not allow default. Refinance them forever. For the next 4 decades, this system repeated itself. Argentina in 2001, Greece in 2010, Sri Lanka in 2022. The names changed. The mechanism did not. With Volcker's innovation, the debt trap became universal. Now step back and look at the completed structure. Peterson created permanent national debt in 1694. Rothschild globalized and interconnected it by 1815. Morgan made borrowing infinite in 1913 through central banking. Volcker made escape impossible in 1982. 4 men, 4 turning points, 1 global system. Today, global debt exceeds $315 trillion. None of it will be repaid. And because debt circulates through banks, funds, and institutions, default anywhere threatens collapse everywhere. Take the United States. More than $38 trillion in debt is split between public institutions like pension funds and the Federal Reserve, and internal programs like Social Security. All of that debt pays interest, nearly $1 trillion a year, funded by taxes. Money flows from workers, government to bondholders, most of whom are institutions owned by the wealthiest segment of society. Scale that across Japan's $9 trillion, Europe's $14 trillion, and the massive debts held inside China, and you see the truth: everyone owes everyone else. Debt has become the bloodstream of the global economy. And here's the reason it can never end. If governments paid off their debt, the money supply would collapse. Dollars and euros and yen are created when governments borrow. Paying the debt would erase that money. The economy would implode, so the borrowing must continue forever. Who benefits? The financial institutions holding the bonds. BlackRock, Vanguard, State Street, Fidelity. Their portfolios contain trillions in government securities, generating streams of interest that never end. Debt service, the money paid simply to maintain existing debt, has become the largest hidden wealth transfer in human history. So understand this clearly: debt is not an accident. Debt is not a mistake. Debt is the foundation of the system. Peterson made it permanent. Rothschild made it global. Morgan made it infinite. Volcker made it permanent. 4 architects, 3 centuries, 1 machine, and every person, government, and economy on Earth now lives inside it.